If you've ever felt like the world of finance starts speaking a totally different language when it talks about sustainability, you are definitely not alone. It's just a world filled with jargon. But the ideas behind it, they're fundamentally reshaping our economy. So in this explainer, we're going to cut through all that noise and get right to the core of what sustainable finance really is. So let's just start with the biggest question right off the bat. Are sustainable, green, and climate finance just different ways of saying the same thing? Well, the short answer is no. And honestly, understanding the differences is pretty crucial, so let's make it crystal clear. All right, here's our game plan. First, we'll decode the language. Then, we're going to follow the money to see just how huge this trend is. After that, we'll peek inside the toolbox to see the financial instruments making it all happen, figure out how performance is actually measured, and finally, explore the new rules of the game being set by regulators. Okay, first up, let's get these terms straight. Once you understand these foundational concepts, everything else just kind of falls into place. I want you to think of sustainable finance as this giant umbrella. It's the biggest, broadest category out there. It covers basically any financial activity. We're talking stocks, bonds, corporate loans, you name it, that brings sustainability factors into the decision-making process. Now, let's zoom in a little. Green finance fits right under that big umbrella. It zeroes in specifically on environmental issues. And it's not just about climate change. This also includes stuff like waste management, how we use water, and protecting biodiversity. And finally, we get to the most laser-focused term, climate finance. This one deals only with climate change, either things that reduce emissions or projects that help us adapt to the impacts. And historically, this term was mostly used to talk about funding from governments and public institutions, though that is starting to change. So, we've got the definitions down. Now for the really interesting parts. Let's follow the money and see just how massive this global movement has become. And believe me, we are talking about a serious amount of capital. Just look at that number. In 2018, sustainably invested assets hit $30.7 trillion. To give you some perspective, that's more than the entire economies of the US and China combined. This is not some niche, feel-good corner of the market anymore. It's a massive, dominant force in the global economy. And what's truly striking here is the speed of it all. This chart shows those assets grew by over a third in just 2 years. That is just explosive growth. It really shows a fundamental shift in how investors are deciding to put their money to work. And this momentum is being driven by some really major players. Take the Net Zero Asset Owner Coalition. It's a group of huge investors who have committed to net zero portfolios. In just over a year, they ballooned from 12 members to 37, and more than doubled the money they managed to $5.7 trillion. That is some serious financial firepower pushing for change. Okay, so the money is clearly there. But how does it actually get from an investor's account into a real-world project? Well, let's open up the toolbox and look at the specific financial instruments that are making it all happen. The most famous tool in the box is probably the green bond. The concept is actually pretty simple. An organization borrows money, but it makes a specific promise and has to report on it to use those funds for a designated green project, like, say, building a new wind farm.
Now, to make sure these bonds are legit, the industry came up with some voluntary guidelines. These green bond principles have 4 core parts that are all about ensuring transparency. It all boils down to making sure the money is used for what was promised, it's managed correctly, and that the results are reported back.
Now, this is a really key distinction. With a green bond, it's all about what you fund. But with a sustainability-linked bond, it's about the borrower's overall performance. See, if the company hits its agreed-upon sustainability targets, its key performance indicators, or KPIs, it actually gets a better interest rate. It's a direct financial incentive for the whole company to improve. And this toolbox is just getting bigger and bigger all the time. We now have bonds specifically for social projects, green loans for corporations, and a huge variety of funds for everyday investors like you and me. You can even get things like green mortgages or car loans now. The innovation is just happening everywhere. Okay, so all of these tools rely on one critical thing: information. I mean, how do you really know if a company is truly sustainable? Let's take a look at the systems that have been built for measurement and accountability. And this is where ESG ratings come in. The goal here is to take a massive, complex amount of information about a company's performance on environmental, social, and governance issues and boil it all down to a single score. It's like a report card that makes it way easier for investors to compare companies at a glance. So you might be wondering, where does all this data come from? Well, investors pull information from a bunch of different places. They'll buy data from external rating agencies, they'll talk directly with a company's management, and they'll dig through official corporate reports and regulatory filings. And having all this data is what empowers investors. What they call engagement, which is really just talking directly to companies about their performance, has become an incredibly powerful tool. When huge investor groups like Climate Action 100 Plus team up, they can put enormous pressure on corporate boards to make real, meaningful changes. All right, final section. With so much money and so much influence at stake, you just knew governments and regulators were going to step in to create some clear standard rules for everyone to follow. What's really fascinating on this slide is the clear trend over time. We've moved from just basic emissions reporting to comprehensive, mandatory disclosures on climate-related financial risks. The direction this is all headed is obvious. More and more transparency is coming. The European Union has taken a really groundbreaking step with its taxonomy. The best way to think about it is like a detailed, science-based dictionary for the entire economy. It's designed to provide one single, clear definition for what economic activities can actually be called environmentally sustainable. The whole point is to try and end greenwashing for good. And let me tell you, the bar is high. To qualify, an activity has to make a substantial contribution to one of 6 environmental goals, like climate mitigation. But, and this is crucial, it also must do no significant harm to the other 5 goals, and it has to meet some basic social standards. It's a really holistic approach. So we've gone from a bunch of confusing buzzwords to a multi-trillion-dollar global system with its own tools, its own metrics, and a rulebook that is rapidly being written. And this really leaves us with one final crucial question. As this entire financial system re-engineers itself around sustainability, what's the biggest impact going to be on our jobs, our industries, and our daily lives? Thanks for joining this explainer.